Wade Webb at Royal LePage, and I'm joined here today with Daryl French from Lending Max. Thanks, Daryl, for coming.
Thanks for having me.
We're going to share with you our Mortgage Minute today, and we're going to talk about the actual planning process and the financial plan. Having a plan in place, not just using a crapshoot method, but having a plan in place that you're considering today, tomorrow, and the future, and looking at all those different situations. So, Daryl, tell us, what does a plan look like for a buyer and for a seller, and how do you go about building a plan and all the things you need to consider in the future and the plans for consumers, please?
Basically, a plan is sitting down with a client and finding out what their goals and aspirations are.
Okay.
You know, do they plan on living in the Okanagan for the next 5-10 years? Or is this a stepping stone they're going to be moving off to wherever?
Right.
Okay? That's one of the things. What are their goals and aspirations for the house? Is it a young couple starting out that are planning on having kids in 2-3 years, or they're going to need some more bedrooms? Or is it a second or third time buyer that wants to start a revenue property?
Okay.
Down the road. It's all these kinds of questions that need to be asked so that we can put some plans in place up front. Because once you've locked into a mortgage, if you lock into a 5-year mortgage, you're
Right.
locked in.
Right.
You can't change it midterm.
So
or if you do, it costs you.
In addition to the family, all of a sudden things change 2 years and you're locked in for a 5-year plan, we've got a problem.
Exactly.
Okay.
Right? Too many people today, I mean, over half the mortgages in Canada, people are not going to term.
Okay.
Okay, so they're paying out their mortgages
Wow,
early.
more than half.
More than half.
Wow.
So more than half the people are paying a penalty of some sort. Okay, that's money out the window.
Right.
That's money that's not invested in the next property.
Typically tell the consumer, tell the viewer what are you looking at for a prepayment penalty or a penalty, what you mean by that?
Our penalties right now are between $5,000 and $10,000 on average.
Wow.
So it's not a small amount of money. It's
Right.
a big chunk of change that just boom, it's out of the transaction.
And that's
now.
because you, the consumer, are changing the original commitment to the lending institution midstream of your 5-year plan.
Yeah, and it can be for many reasons, good reasons, right?
Right.
Just like we said, maybe you had kids, maybe you had twins, and you need the bigger house, right?
Right.
So you need to move. Some mortgages today aren't portable.
Okay.
Well, when you want to make the move is not the time you want
So
to find
tell
out.
us more about portability. What is a portability and portable
Portable
mortgage?
means you can take your financing with you from one house to the next.
Okay.
Okay, so if you sell this house, buy the next bigger house, and you need to top it up, you can top up, add a little bit to that mortgage, but you're taking the basic financing with you, so there's no penalty involved.
But that's not true for every mortgage.
But not every mortgage is portable.
Right.
And that's the problem today. More and more mortgages today are actually not portable.
Okay.
And so it's really important to know those things day one. And that's why, again, creating that plan.
Okay.
Okay. Another big thing is assumability.
Right. So tell us about what it means by for someone assuming or using assumable mortgages.
Yeah, it's really been years, because for years now we've seen the rates going down. So when you assume somebody's financing, you actually take over their existing financing.
And why would you take over someone's?
Because someone doesn't want to pay a penalty to move on. They're moving out, they're not buying another house, or they're moving out of an area where they can't get financing with that lender.
Right.
So they would be otherwise facing a penalty.
Yeah.
Someone can take over their financing.
Right.
At today,
And save that.
Yeah, so in 2 years' time, interest rates have gone up a point or two. All of a sudden, that becomes a sales incentive
Right.
to stay with the house.
Right.
So now they're motivated to leave the financing behind.
So they're saving that prepayment penalty on the seller's side, and the purchasers obviously, maybe if increasing your interest rates, the rates probably going rate today in the market is higher than what that rate was when they established that mortgage 2-3 years ago, and the buyer benefits from taking over that.
So if they got
package.
2 houses that are looking pretty equal,
Right.
that assumable mortgage could
Right.
be the difference on making the sale there.
Right, and it's a win-win for buyer and
Win-win.
seller, because seller avoids the prepayment penalty, buyer wins because he's saving on a lower interest rate for another couple years.
Exactly.
Great.
So again, not every mortgage has an assumable clause in it.
Right.
It's really important to find out before you lock into the mortgage about these different clauses. Having that plan in place can be crucial and save you literally tens of thousands of dollars.
Other areas for plans.
Well, I think there's little things like payments. Right? If I were to walk up to you, Wade, and say, you know, if you didn't have $100 a month,
Right.
if I took $100 out of your out of your wallet every month, would that dramatically change your lifestyle?
Probably not.
Probably
I
not.
hope not. Yeah.
Okay, right? But if you ask most people, they
Right.
actually probably do without that.
Okay.
If you look at what that $100 a month could do to build equity to put you in a position where you could buy that next house,
Right.
buy that revenue property,
Right.
start doing those kinds
So you're
of
making a
things.
little slight increased pop-up payment and an additional balloon payment on top of that on a
Exactly.
regular basis, and all of a sudden you're increasing your equity and the value of your investment on an incredible basis.
That's right.
Right, and then also now would frequency then have a similar type of impact?
Exact same thing, because you're basically changing from monthly payments to bi-weekly payments is really doing the same kind of thing.
And are those the only two options?
You can pay anything from weekly, bi-weekly, monthly.
Okay.
So you've got those different options. But any of the shorter terms, you're paying more money down,
Right.
and that's reducing your principal
And increasing your
and increasing your equity, so that you're in a position to either move up, buy the revenue property, do whatever else.
Right.
Because we've talked about this in the past. Was it about 7-8 years is the average cycle that someone owns a home?
Correct.
Okay. If you could shorten that, if you think about it, if you could shorten by 2 or 3 years, that's a pretty big windfall for the real estate industry.
I just recently heard that the first-time buyers average is 3 years. They're moving in 3 years' time after first-time buy. So,
Right.
so 7-8 years for the average Canadian on their second or third time around.
Yeah.
On the first time around, they're averaging 3. So again, first-time home buyers, why would you consider anything longer than a 3 year if the average Canadian's doing something different in 3 years' time?
It
Yeah.
makes sense.
Right.
Okay. So there's things you want to look at that way. You want to structure the payments and say, okay, well, my next house is probably going to be, if they bought a house for $300,000, my next house I'm probably going to be in the $500,000.
Right.
So I'm going to need X amount of equity in 3 years' time
Okay.
to be able to afford that.
Right.
You look at the numbers and go, okay, well, the market would have to go up by a lot. We don't want to be reliant on the market. We
Or
want
the
that to be a
economy,
bonus,
yes, for
right?
sure.
So we want to look at, okay, well, what can I do to my mortgage to accomplish that goal?
Right.
And there's lots of very simple things. Like I said, it could be $50 a month, it could be $100 a month. They're not enormous changes,
Right.
but they really make a big difference down the road.
Okay. Other areas of the plan?
Other things, setting up whether you're doing fixed or variable, right?
So tell us
There's
the difference
still
between a fixed mortgage and a variable mortgage.
Fixed mortgage, your interest rate is locked in, your payments are locked in for the terms. If
For
you
the
have a
term.
3-year
Yeah.
term, it's locked
That's
in.
it.
Variable is floating based on prime. We
Okay.
haven't seen change in prime in almost 4 years now.
Right.
But we're expecting to see that later next year.
Okay.
So does that mean that now's a bad time to take a variable?
Maybe, maybe not.
Maybe, maybe not. I don't think it is a terrible time.
Right.
They just interviewed 35, I think it was, economists in Canada, and unanimously it came out to the fourth quarter of next year will be the first time we see a change in prime.
Yeah.
So if you can get a prime rate, which is now, the variable rates were about the same as the longer term rates,
Right.
where that's changed. Now the variable rates are a little bit below the longer term rates.
Tell us who a variable rate consumer, a type ideal client would be a variable rate
Yeah.
client versus a fixed client.
It's someone who's got the stomach for it. If your interest rate,
Not for the faint of heart.
no, it's not. If your
Right.
interest rate's going to keep you awake at night, I don't care what your debt service ratios,
Yeah.
how financially set you are.
Right.
If it's going to keep you awake at night, don't take it. Life's too short.
Right. And history tells you, though, over a 10-year period, if you gamble on the variable and you can stomach it and you can manage that, how does it impact you?
9 out of 10 times, the variable rate's going to be less expensive.
Right.
Key thing though on the variable rates, a lot of variable rates today, variable rate mortgages today aren't portable. So we talked earlier about
Right.
the portability.
Right.
A lot of them aren't portable and assumable. Okay, so that's a really important thing to know.
Okay.
A lot of them also, you don't have with some of them you have the ability to lock in at the discounted rate at that time. So say you wanted to lock in, you've been on a variable rate for 2 years, you think the rates are going to start to go up, you're not comfortable with it anymore, you want to lock in. Some lenders will guarantee you their maximum discount at that time.
Right.
Other lenders won't give you any discount because they've already got you locked in. For you to leave, you got to pay a penalty again.
Right.
Okay, so again, it's these little things, knowing and understanding those things and having a plan on it. Maybe if you want to take the variable rate now, save in the short term, you better have with a lender, and that's where we can help you out, with a lender that has the lock-in policy
Right.
at the discounted rates, and then we stick you on a plan where we're going to be in touch with you every quarter
Okay.
and keep an eye on things,
Right.
right? And so, plans are changeable. But it's having that plan up front, making sure the options are available to you to make those changes down the road.
Great. Great advice, and now you've heard it from one of the experts and the importance of a plan and all the different factors that need to be considered. Again, consult your mortgage professional or your real estate professional and find out what the ideal plan is and consider all these different scenarios and all these different situations that Daryl shared with you today. Thanks, Daryl, for your time. That's Mortgage Minute with Wade Webb from Royal LePage Kelowna and Daryl French from LendingMax. Thanks for your time, folks. Have a great day.
Have a good day.